Hello, I'm Adrian Gonzalez, president of Adelante SCM, and it's great to be back as your host for this March 2023 edition of Transporeon Journal Market Updates. When I was a kid growing up in New York City, the mayor at the time was Ed Koch, and he was famous for always asking, "How am I doing?" to city residents. Collectively, those of us in the supply chain logistics industry can ask a similar question. How are we doing? Well, at the macro level, we're still dealing with a lot of issues. We just passed the 1-year mark since the start of the Russia-Ukraine war, and unfortunately, little progress has been made in ending the conflict. In just the past few weeks, we've seen balloons from China flying over the United States, North Korea firing long-range cruise missiles, and Iran producing enriched uranium that is close to weapons grade. Therefore, it's not surprising that in a survey conducted in January 2023 with Indago's supply chain research community, geopolitical-related disruptions ranked second on the list of risks supply chain professionals need to plan for more effectively moving forward. In case you're wondering, labor shortage ranked first by a small margin. On the economic front, the International Monetary Fund, in a January 2023 update, projects global growth to increase 2.9% in 2023, which is 0.2 percentage points higher than it predicted in October 2022. However, this is still significantly below the historical average of 3.8% from 2000 to 2019. The IMF also expects global inflation to fall from 8.8% in 2022 to 6.6% in 2023 and 4.3% in 2024, which is still above pre-pandemic levels of about 3.5%. However, the latest inflation data from Germany, France, and Spain show that bringing down inflation remains a big challenge. As reported by Bloomberg on March 1st, consumer prices in Germany advanced 9.3% in February from a year ago, up from January's 9.2% gain, driven by services and food costs. Meanwhile, as Bloomberg reported on February 28th, consumer prices in France jumped by a euro area record 7.2% from a year ago in February, and Spain saw a 6.1% increase. Analysts had estimated price gains will remain unchanged at 7% in France and to slow in Spain. Put all these puzzle pieces together, and what you get is a not-so-pretty picture of the global economy in the months ahead. How are we doing from a transportation standpoint? Let's take a look at data from Market Insights to get some perspective. On the morning of this recording, the Market Insights dashboard shows various trends over the past 13 months. If you look at the capacity index, for example, it was 94.2 in February 2022. A reading under 100 indicates a capacity-constrained environment. In February 2023, however, the capacity index was 112.1, a 19% year-over-year increase. In other words, we're starting this year with significantly more capacity in the market than at the beginning of last year. As you would expect, this increase in available capacity is leading to a reduction in spot prices. The spot price index, which tracks the spot rate across 70 major lanes in Europe and weighs each lane according to its transport performance, was 108.3 in February 2023, an 11% decrease from February 2022. Changes in contract prices take longer to materialize due to the timing of procurement cycles. If you look at the contract price index, which tracks the contract rate across the same 70 major European lanes, it was 110.9 in February 2022. It increased to a high of 123.7 in August 2022, which better aligned contract rates with spot rates at the time. Since then, however, the contract price index has remained relatively flat, down slightly to 122.4 in February 2023. Based on the trends we are seeing in the capacity index and the spot price index, it's likely that we'll see reductions in the contract price index in the months ahead. Similar trends are evident in specific lanes. For example, on the morning of this recording, if you look at the Germany to France lane, you'll see that the spot rate is down 16% year over year, and the contract rate is up 8% year over year. You can also see how spot rates were above contract rates for the first 10 months of 2022, then they dipped below contract rates beginning in November 2022, and have remained there through the beginning of 2023 so far. Of course, not all lanes follow these trends. For example, let's compare the Latvia to Estonia lane with the UK to France lane. In contrast to the overall market trend, spot rates for the Latvia to Estonia have actually increased 32% year over year, while spot rates for the UK to France lane have decreased 23% year over year, a much greater decline than the 11% decrease in the spot price index. This illustrates once again how the transportation market is not homogeneous. You really have to look at it on a lane-by-lane basis. Let's take a look at one more index, the EU Cost Index, that shows the evolution of costs for trucking carriers across the 70 biggest lanes in Europe. It aggregates data into 5 clusters which represent the 5 biggest cost factors for carriers: driver costs, fuel and AdBlue, vehicle, toll, and services, and sums it up into a single index via a total cost of ownership calculation model. The index has a baseline of 100, which represents the average cost seen in the last 2 quarters of 2019. This means that values larger than the baseline represent an increase in cost. In Q4 2022, the cost index was 120.75, significantly higher than the 105.75 reading in Q4 2021. As you might expect, the big increase in fuel costs, which was sparked by the Russia-Ukraine war and other factors, has been the main reason. The cost index is forecasted to increase to 121.43 in Q1 2023 and to 122.59 in Q2 2023, driven in part by expected increases in labor costs, which remains the largest component of total cost for carriers. The combination of increasing operating costs with decreasing rates and freight demand means that carriers now find themselves between a rock and a hard place. Unfortunately, those who are unable to remain profitable will likely go out of business. Moving on, how are we doing in ocean transportation? Are ocean carriers heading into a pricing war? How should shippers approach their next contract negotiations? To share some insights and advice on what's happening in the ocean market, I'm excited to have Patrick Pretorius, Director of Business Development North America at Transporeon, joining me on the program today. Patrick, thank you for making the time to be here. What are some key developments in the ocean market? What words of advice do you have for shippers?
Hi, Adrian. Thank you very much for the introduction and for having me. Very pleased to be here. Our outlook for 2023 actually started in Q3 last year. We have some clients that run their bids quite early on. So think rates that are going live in April this year, negotiated already started towards the tail end of Q3 last year. So that's just their typical contract negotiation cycle. They've been doing that for many years. But what's interesting is they manage quite a lot of freight. They have almost 1,000 lanes, and they go out quite early, and we kind of use that to get a sense of what carriers are anticipating for the oncoming year, right? What we saw was obviously very sharp contrast. So not just in terms of cost, which I think was the first and foremost thing that confirmed what we had suspected, but also specifically in terms of incumbency and lanes that might have been missing offers. So if we went back 1 year prior, we saw in that large bid around 30% of lanes where incumbents simply hadn't offered on their own lanes, right? Which I think painted that somewhat bleak picture that shippers were looking at going into 2022. I'm happy to report that had dropped down from 30% to just 5%, which is a pretty common, or let's say average amount of lanes where incumbents might just be shifting their sailing schedules or something like that, right? So first signs of something sort of somewhat beneficial to shippers on the horizon, starting towards the tail end of Q3, headed into Q4. That bid concluded in Q4, and then we saw more and more shippers heading out to the market. Information started to circulate that rates were softening. We saw the tide shift, not just in terms of number of bids. So we saw more bids being launched, but also in the split between what were spot rate requests and then the kind of more traditional strategic or contract negotiation exercises, right? So not just one or two or a handful of lanes, but shippers going back to bidding out their kind of entire network, with contract validity ranging anywhere from 6 months to 12 months, but again, tending more towards those long-term kind of 12-month rates. Added to that, we also saw some really nice trends in terms of cost efficiency. Another kind of anecdote, but still you start to see a pattern. A client that wrapped up a bid round one at the end of January, and then when round two concluded at the end of February, their rates in some cases had gone down by as much as 90%. So really, we are starting to see on the technology side these kind of signs that the market is pretty primed for shippers to go out. There's still some challenges, right? You hear about USA to India staying high, transit time still not being as reliable as some folks had hoped. And then looking to the future, obviously, there's still a fair amount of instability out there. We've got conflict, we've got global economic situation, demand decreasing to a degree, warehouses kind of getting full. So what we see here with everything going on and the amount of activity, it kind of seems like the optimal time over the last, or compared to the last few years to go out to the market and lock in some good rates. As well, on the technology side, we see certain shippers deploying a couple of nice capabilities that are pretty interesting. The allocation optimization tool helps them to focus their awards to specific partners by region or by business unit, while also favoring incumbents where needed. So kind of finding the most cost-effective solution that can still meet strategic objectives. And then we see a large uptick in demand for global rate repository solutions. So allowing, in fact, suppliers to come in and make modifications to rates that are then approved by the shipper and then visible to the entire global ocean freight stakeholder community within that shipper organization. So massive efficiency gain there. That was all I wanted to share with the audience. So thank you very much for your time. Thanks for watching, and thanks to you as well, Adrian. I'll pass it back to you.
Thank you, Patrick, for the update and great insights. It'll be interesting to see how things unfold in the ocean market in the months ahead, especially with so many variables involved. Shifting gears, as we highlighted in our Pulse 2023 report, whether it's driven by regulations, trading partners, shareholders, employees, or consumers, it's abundantly clear that sustainability is becoming a factor in supply chain decision-making, along with cost, service, risk, and resilience. What are some important developments in the sustainability realm? How can companies continue to move up the maturity curve in this area? To help shed some light on these questions, I'm excited to welcome another special guest to the program, Jacob Muse, who's Director of Sustainability Tribe at Transporeon. Jacob, it's great to have you on the program. You know, sustainability is literally in your job title. So obviously you have a strong pulse on what's happening in the industry. So please share with us some highlights of what's happening with regards to supply chain sustainability. And since March is Sustainability Month at Transporeon, what activities are happening at the company?
Thank you very much, Adrian. Many things have happened in in sustainability the last couple of months. We see that there's been some changes in how customers and potential customers are behaving, what they're looking for. In Europe, there has been a bigger focus, mainly due to the legislation that's upcoming and the rumors of the legislation. In North America, we do see a focus on the opportunity to get a better overview over your transport systems and your network. So we do see another approach to customers. What they all have in common is that 6 months ago, most customers would come to us and look for an automated and accredited measurement of CO2 emission. So those were the two biggest values. Now customers often ask for precise measurements, so using primary consumption data, and also disaggregated calculation, meaning that they want to consume the calculations in other tools. So we have outbound APIs. And the biggest change we have is that customers have started to ask for not measuring CO2 emissions, but lowering CO2 emissions. So we do see a change from this overall, let's measure something, to go in and say, no, we need to measure it so that we can lower it. And in order to lower CO2 emissions, you need to have precise measurements, disaggregated on a product level, and so on and so forth. So things are moving, definitely. This month, March, is our sustainability month, and everyone and anyone who's interested is welcome to look into on our website or in our social media channels to get an overview over how what we have talked about this month and which options they have with Transporeon to lower CO2 emissions. We have also started presenting our new products. We have carbon visibility, which is in 2 solutions for customers. And we have carbon intelligence, which we expect will come on the market in the second half of 2023. Carbon intelligence will help you lower your CO2 emissions. Carbon visibility will help you make precise measurement of your CO2 emissions so that you can lower them. And with that, I would say thank you very much, and back to you, Adrian.
Thank you, Jacob, for the informative update. This is another area where a lot is happening across many fronts, not just with regulations, but with technology too. There is no doubt that sustainability, if it isn't already, will become a defined and measured objective within supply chain organizations moving forward. So, how are we doing overall in the supply chain logistics industry? I guess it depends on who you ask. For shippers, the current environment from a rates and capacity standpoint is much more favorable than it has been the past 2 years. For carriers, however, it's a more challenging environment as they try to balance lower freight demand and decreasing rates with higher operating costs. What hasn't changed is the need for shippers and carriers to build truly collaborative relationships. To quote from the book Getting to We by Kate Vitasic from the University of Tennessee, quote, "More and more, business success depends on strategic relationships built for an ever-dynamic and interconnected world that will endure long after the deal is done. For many organizations, this ongoing relationship is as important as the deal itself. The focus needs to be on developing evolving and mutually beneficial relationships that create shared value, solve mutual problems, and get both parties to a place of we rather than the usual us versus them tug of war. I think we can all agree that we continue to face a lot of risk and uncertainty in the market. The answer to how we doing would undoubtedly change in the weeks and months ahead, which is why staying informed of what's happening in the world, with regulations, the economy, geopolitical activities, transportation and labor markets, the competitive landscape, emerging technologies, and so on, is as important as ever. Thank you for watching this edition of Transporeon Journal Market Updates.